Well, it's a very good morning from him, and of course it's a very good morning from me. Welcome to my mortgage live stream. I hope you're well on this beautiful day again. We've had so much sunshine on the video, but it's all changing this weekend. Apparently the weather is deteriorating somewhat. Talking about all change today, got a video clip for you about low start mortgages, which is to kind of update you with CeMAP and all those things. But do you know, I'm seeing some really important changes coming through in the market at the moment. There's a bit of a storm happening, if you like. We've got the Labour government, of course, who are driving growth, economic growth. Everything's about creating growth in the economy. And they will do that because, you know, they're smart people. And it will happen slowly, but it'll begin to happen. It's happening already in the mortgage market. And they've encouraged the regulator to loosen the straitjackets, if you like, to let lenders lend how they wish to lend, really. And there's pent-up demand from first-time buyers who haven't got deposits and stuff like that. So I saw this new mortgage from a company called Gable Mortgages, 100%. How cool is that? They're back, full 100% mortgage. And I was watching Phil and Kirsty, their program Location, which I love, by the way. And great program, great presenters. And back in 2003, I think it was, or 4, they helped this couple in Nottingham to buy a house with a 100% mortgage. And of course, they were very popular back in 2003, 2004. Now, they went back to see them last year, I think it was, they recorded it. But these two guys, they bought a couple of houses since. They've got a great big house, big family, everything. It's lovely. But they wouldn't have been able to do it without the 100% mortgage. And we're seeing lots of 95% mortgages. And I want to talk about the Skipton's delayed start mortgage today as well. So what we're finding now is there's a lot more lending coming in from lenders, which allows them to lend more and higher loan to values to first-time buyers that need that kind of stuff. Back in the 80s, 90s, we had 100% mortgages. They've always been around. It was only after the financial crash when they killed them off because bad lending killed the economy. You know, it was rubbish. It was bad lending in the US that did that, but that's another story. So good news for you if you're in the mortgage broking world. If you're in the advising world, of course, you're probably working for a bank that does it anyway. But if you're in the broking world, then you might want to think about the kind of first-time buyers you might want to be attracting. That's really where I'm going with that. Not all of them, because many of them will just go straight to the banks to get their money. But some of them that may be wanting the 100% mortgage, and I believe the Gable Mortgages is only available through intermediaries, so they'll have to use a broker. So start your prospecting now for that kind of person. Do it online, of course. You want to do it through Instagram, TikTok, LinkedIn possibly. I wouldn't bother with Facebook because the younger people aren't on it. And I would start to talk about these high lending mortgages and how they're available and how they need to see you to talk about it. And that way you'll get yourself some good business. Things are going to start moving and the autumn interest rates coming down. It's really looking quite good. I've seen it before. I've seen them. I've been in business since 1983 I started. What's that, 40 odd years now? Therefore, I've seen these things happening. And when you've seen it before, the same kind of hints come in, the same trends come in, and market's certainly going to pick up. Anyway, enough of that. I hope you're well. I hope you're good, enjoying yourself, having fun, as they say. So we're going to go over to Whiteboard in a minute. We're going to take a look at the subject of low start mortgages. I want to talk to you about how they work, just to update you, but also if you're doing your CeMAPs, it's all good stuff. Because we put these on our boot camps, which are all structured. The whole syllabus is laid down in the right structure with lots of videos and stuff like that as well. So without any further ado, let's pop over to the whiteboard, shall we? Ta-da! Okay, let's take a look at the subject of low start mortgages with you. And I got here since the 90s, which is great. So we'll see if that works out, shall we? Now, let's put a little time zone in, show you a little timeline and see where we go with that. Because I've got a little timeline now just to sort of show you where we are and the timings involved. So let's kick off now in 2025. And what I'm going to do for your further enjoyment is go all the way back to the 1990s, because low start mortgages have been around for, as you can see, 35, 40 odd years. They're not a new thing. Now, the Skiptons just brought in their new delayed start mortgage. Let's just take a look at that one, shall we, with some depth for you. Now, the whole point about a low start mortgage is it allows the first-time buyer typically to buy a property with a mortgage, usually a high percentage mortgage, but they don't have to make payments for a little while, or they pay lower than everybody else. In other words, they have a low start option, so they can, buy the furniture and do the property up, etc. Now, the Skipton, as I mentioned to you, have got this thing called their delayed start mortgage. That's just a marketing term, isn't it? But it's a low start mortgage. So how does it work then? So let's just pick up on my little graph here for you, just to illustrate that for you. Now, here's my graph for you. And the graph represents two things. We'll do a lot of these as well. The vertical there represents the amount of money involved here. And this one represents the term or time. And the way that the Skipton works is that they give you 3 months off of your mortgage payment. Simple as that. So that's your mortgage payment. So if we just draw a line in there, let's get a red pen for this one, shall we? There you go. Let's put a few pens down there. So what happens with the Skiptons, you normally have a fixed rate maybe for a couple of years, then maybe your fixed rate goes up again, and maybe your fixed rate goes down again. That's just how interest rates, so that's your monthly payment, which is fixed, of course, with these things. Now, for the first 3 months of your mortgage, so let's just squeeze in there 3 months for you. There you go. You don't have to make any payments. That's the whole point. But that money that you don't make payments to, obviously you're not reducing capital, are you? But the interest is actually added to your loan outstanding. So this amount of money here, which is 3 months of interest, is actually added to your loan. So come 3 months later, you actually will have a slightly bigger mortgage, and your monthly payments are then worked out on that one. So that's pretty much how that one works. Now, the great thing about the delayed start mortgage is it's a 95% loan to value. So that's really good, isn't it? And also you've got the joint borrower sole proprietor feature, which again, that's not a marketing term, is it? That's where you have, they call that the income booster, but that's where you have 2 borrowers with one person owning the house. Usually the young person owns the house, and he or she will be maybe with a parent or somebody who has more of an income. So there's 2 borrowers, but only the young person is the proprietor of the property. So that's the delayed start at Skipton. Now, of course, this happened a couple of years ago, of course, with COVID. They called them payment holidays back then. So let's just draw the picture of this one for you. Here's your COVID graph for you. Again, same thing. And they call this the payment holiday. And Boris Johnson announced this in the round about March, I think it was Rishi Sunak as Chancellor, April 2020, that anybody could apply to their lender and have 3 months off their mortgage payment. Hello. And most people did. And it's the same issue there, isn't it? You had interest rate maybe fixed or whatever was your rate. Just put that up there for you. And that's the term. There you go, number of years. It was the same thing. So people's mortgages were already in existence. They applied to their lender and they got themselves 3 months off. So effectively, you would have, say, this period of time. Let's just put that in there for you, 3 months. But again, that interest that wasn't paid, obviously the capital wasn't being reduced either, but the interest that wasn't paid was then added to the loan at the end of the 3 months, and somebody had a bigger mortgage in which they had to make mortgage payments on. That was what's called the COVID mortgage payment holiday thing, which, okay, well, it worked because the government's so worried about people losing their jobs and obviously not having any money, so they tried to do everything they possibly could. Okay, then go back a few more years then to different types of low start mortgages that we've had in the past. Go back into the kind of 2020 onwards. Let's just put the date in there for you, 2020 onwards, and we'll put in there 2000, and we'll put in there 2010 to see where we were. You had another low start mortgage, which lenders promoted, and you may have read about this in your textbook as well, because these things all get mixed in, don't they? But this wasn't really a low start mortgage, so let's just call it the word they call it. They call it a low start. Again, we'll put our little graph in here for you. But this time we'll do the monthly payment as opposed to the interest rate as opposed to it. So let's just put that in there for you. And what happened with the low start mortgage is that you paid interest only for a couple of years, 2 or 3 years really. So if you think about it, red represents your interest only payment, and the black, let's put a black pen in there for you, represents capital and interest, which, as you can appreciate, of course, is always more because you're paying capital. Now, the interest payment for the first 3 years, typically with a low start mortgage, you would pay interest only. So that's your payment there for you. Where, of course, the capital payment would have been more, but you didn't pay that. So effectively what's happened here is your monthly payment is a lot lower, which helps you out, but you're not not paying interest, so you're not seeing your mortgage go up at all. The mortgage debt remains the same. Now, what happened then with these types of mortgages, after the period of 3 years or so, interest only stopped, and you went to be paying capital and interest then. Keep the colours right for you. And then you carried on paying capital and interest at whatever rate you paid. So effectively what you've got was this amount of money here, which was capital payments you didn't make for 3 years. That's what you saved. So they called that the low start mortgage. And I suppose in a sense it probably was a low start mortgage, wasn't it? So that's another type of low start mortgage. There's lots of different categories, isn't there? I suppose arguably, and these were very popular in the turn of the century as well, and this has been popular for a long time, is the standard cashback mortgage. Now, cashback mortgage, which come and go with popularity really, they're standard variable rate mortgages with a lender, no frills at all. And what they do is they give you money, they give you cash, a bit like you use your credit card to make payments. The credit card company pays you money, don't they, some of them? And the cashback mortgage is the same. You borrow your money at normal rates, so lender would make good profit from that mortgage. And as a result of the good profit they're making, they can pay you a couple of grand in cash, tax-free. It gets paid back if you pay the loan off early, but if you keep the mortgage going forever, you don't have to pay that back. So I suppose in a way that's low start. But the real first low start mortgages need to go back right to 1990. And I'll call these the deferred mortgages. Deferred. Now these are the mortgages that gave the low start a bad name, really. And I'll explain how these work, because I advised these things at the Pru back in the late 80s, early 90s. Now, what happened back then is interest rates were really quite high. In the early 90s, we had interest rates of up to about 16% at one point, which were really high, and people struggled. People moan nowadays that payments are high, but back then they were 16% interest rate on your mortgage. Eventually, people had smaller mortgages, I suppose, but even so, they were expensive. And what we found is people wanted to pay less. So we invented this thing called the deferred mortgage. And effectively, it was the same as the delayed start in a way, but it was for longer than 3 months. So if we look at this with our graph as well, you had two payment rates. You had the charging rate, I'll put that in red for you, and you had the payment rate. Actually, let's put that in a different colour. Keep the colours the same, shall we? So we know where we stand there, don't we? There you go. So you had the normal rate in which everybody was charged to your mortgage. So down here we've got it in black, haven't we? So your normal rate, and of course they were variable back then as well. So that's your normal rate, because they were variable rates. They weren't fixed pretty much in those days. That's your charging rate. In other words, that's the rate in which your mortgage is charged at. So that's the interest rate that you're charged every day on your mortgage. But what people had with these deferred mortgages is they had a 3 or 4 or 5 year period where they made payments at the payment rate. And the payment rate was typically, let's put that in there for you, say minus 5%. So for the first year, you might get 5% off of your mortgage payment. So that's great, isn't it? So let's just follow the pattern that we got there. And in the second year, you might have had minus 4%. So obviously it went up a little bit, but it still tracks the thing as well. So you can see what I'm doing. And then maybe in the third year, it was minus 3%. And then it kind of went even closer. Now, some gave a minus 3% for 5 years, but you're paying a much lower interest rate all that time. You're paying capital as well, although sometimes these were interest only because they had endowments back in those days. We sold endowments to attract it. But what you found there is that you had an awful lot of unpaid interest, which wasn't given away as a gift. This unpaid interest, let's put that in there for you, unpaid interest. This unpaid interest was accumulated at the end of the term or end of the 5 year low start period. This unpaid interest was then added to the capital outstanding, which of course had the effect of massively increasing your monthly payments. Sometimes there were sort of £3,000, £4,000, £5,000 added onto the mortgage. And mortgages in those days were 60, 70 grand each, so a big proportion. And therefore people's payments rocketed back upwards. So they were pretty painful things. but they allowed people to get a mortgage and afford the monthly payments. That was the whole point behind it. And they were known as deferred mortgages or low start mortgages. And they kind of bred the thing. The Skipton's delayed start's only for 3 months, so it's not a huge deal, is it? But if it's for 3 years, you can see the amount of unpaid interest that caused the problem. So that was low start. You might have come across in the book the thing called the annual review mortgage. Now that was introduced in the early 90s. I mention it because it's nothing to do with being low start, but it was confused as such. Now with the annual review mortgage, again, similar graph here, what we had in those days, and the government found problematic, was that interest rates would go up and down, of course, because they were variable. So the lenders introduced this thing called the annual review system. And because interest rates kept going up and down like a yo-yo, lenders got fed up sending letters out to everybody. This is before email, and it was costing them a fortune. So lenders said, well, rather than change everybody's rates each month, why don't we change them once a year to take into account all of the changes that have occurred? So the normal interest rate, we'll put that in there as sort of, a rate anyway. The normal interest rate would go up and down like a yo-yo, wouldn't it? And the lenders would get really fed up with that. It's going up there and it's coming down and it's going back up again. That's what would happen. So the lender said, look, let's just each year find out what somebody needs to pay for the year. So if you put that in there across there for 1 year, and then the following year they'll then review what unpaid interest it was. So maybe your rate went up to that one for another year. So effectively, you paid the same amount of interest all the way through, but only required one monthly payment, or one annual payment, or one monthly payment reviewed annually, which never changed. Now, well, what happened there is that the government didn't like those things, so they came in and they stopped them, because it meant that when interest rates were coming down, people didn't benefit from it until the end of the year, you see. That's known as the annual review mortgage, which you might have come across in the book or in your studies and those sort of things. So as you can see, there's an awful lot of low start mortgage, isn't it, all the way through. I hope you enjoyed all my little piggies. This is the one that's the latest one. I think it's a great idea. I really do. I do think that the 100% mortgage is a better idea, and somebody should make their payments all the time. You need to get used to making your monthly payments. Most people have been renting, so they're used to paying rent every month. The rent's pretty high, isn't it? Private rental. So that could certainly make a difference in the market. So there we have low start mortgages since the 90s. Bye. Well done, well done, well done, well done. Nice one. Okay, let's move on then for our last section today on our mortgage live stream with you. And as always, I just want to give you a little sales idea, really, to make you think about selling, advising, running a business, all those good things. And this one I've called An Itchy Back Needs a Good Scratch. Now, we've all been there before, haven't we? Trying to make a balloon impression on a tree, or attempting to reach a part of your back that no human fingernail can ever reach, to relieve ourselves of that annoying itch. You ever been there? It's horrible, isn't it? Now, this concept or this metaphor is very helpful when considering our customers and what they might need from us. Needs, of course, is what we need to look for in order to provide the solution. Now, I've called this an itch and a scratch. So let me explain a couple of examples for you. Now, last year, we arrived at an airport in Spain, which was 50 kilometres from our apartment by the sea. Now, my itch was getting there. Now, second example, it's New Year's Day, and my resolution is to embrace more mindfulness this year. Again, that's my itch. Third example for you, we're off to spend 2 weeks in Edinburgh in March with the long-term intention of moving house there. My itch, where on earth do we start? Now, our role as salesperson, advisor, is to offer the best scratch to our customers' itch. Here's how, using those examples I showed you earlier. Now, when we were abroad in Spain, a quick hire car from the airport was the best scratch at Girona Airport, and we drove those 50 kilometres to our apartment. Now, for my mindfulness itch, a 4-week course at Cheltenham Lido, which started in February, was my scratch. And where do we start in Edinburgh? Well, we picked up a book called 21 Walks Around Edinburgh, and that became the scratch that satisfied my itch. Now, if you've never seen Baloo scratching his back on Jungle Book, you have to watch it. It's on YouTube. It's a real hoot. It goes something like this, but the music is brilliant. Nice one. Hope you enjoyed that. Just a little sales idea there for you, as always, isn't it? Okay, lots going on here in the business, so keep in touch with us. We've got a few sort of special offers coming through. We've got some books that we're selling off because new stocks are coming in, so keep in touch with us on that one as well. Some CeMAP books and things. We've got the equity release boot camp and training coming through as well, so lots happening. As always, if you're interested in getting onto our database, or our member hub as we call it, you can obviously get me on there as well. And that allows you to go onto the hub, and we'll keep you informed with lots of things. We send out an emailer on Monday night, which has an article for you, a mortgage article. And Sunday, if you're interested, we send you a more salesy article as well, which we send out every week, and you can enjoy those with our compliments. We've also got a CPD hub, which is available for free as well. And we've got all of these live streams and videos and writings that I do, all in one convenient space. Sounds very marketing, doesn't it? Other than that, I hope you have a fantastic week ahead coming up. Enjoy yourselves, have fun in the sunshine, and we'll see you next week. Bye.